Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. So in this latest Moneymakers Investment Trust podcast, I've got an opportunity to talk to the chairman of another sizable investment trust. You can make an argument that actually it's more important to be talking to the chairs of boards these days rather than necessarily just to the fund managers, because there's so many issues that boards are having to wrestle with at the moment, not least of which is discounts and activity on the share register. This chair, who I'm about to talk to, is Glen Suarez, and he is the current chair of Impax Environmental Markets, ticker IEM, which has a market cap of around 770 million, so a decent-sized beast, and net assets of 850 million, and therefore, by definition, trading at around a 10% discount. It's been on the market for quite a long time, has a very distinctive approach, investing in clean energy, waste, water, those kind of things that can make the world a more sustainable place. But also, of interest is that in a prior incarnation, Glen was the chairman of Edinburgh Investment Trust, and was presiding when the mandate for that particular trust was moved away from Invesco Perpetual to a new manager. At the same time, he's also non-executive director of Bluefield Solar Income, one of the alternative trusts that is still listed on the London market. And on top of all that, he is the chairman of a fund management company called Knight Vinca. So that's quite a lot of mouthful, Glen. I'm sorry to put you through all that, but let's kick off, may I, by saying thank you for coming on the podcast and for giving us a chairman's perspective at this very interesting time in the investment trust cycle. So is it fair to say that all directors of investment trusts are having to work a little bit harder at the moment than they have done at some times in the past?
I think that is entirely fair. I think anyone who thought that being a non-executive director of an investment trust was going to be a sinecure, I think will have been badly misled. The last few years have been very, very difficult and a real challenge for directors and for managers and for the investment community as a whole. And directors really have had to step up to play a very proactive role in governance and understanding risk, performance, benchmarks. It's a completely different world, I would say, from probably 20 years ago, where there are very significant challenges.
So perhaps we could start by talking about your experiences as the chairman of the Edinburgh Investment Trust, which was a UK equity income trust managed for many years by Mark Barnett of Invesco Perpetual, and before that, other managers of repute. But you took the decision to move the mandate away from that trust back in 2019. What was your thinking at the time? And do you regard changing the mandate as something of a last step for a trust that's run into difficulties, or is it actually something that perhaps you wish you'd done a little bit earlier?
It's a very good question. Let's start with what is my philosophy about managers and boards. For a start, when you're investing, you have to take a long-term perspective. And the long-term perspective is necessary because by definition, what you're trying to get the manager to do is to find opportunities that the market hasn't seen and which have an opportunity for outperformance. But by definition, there are times when the manager will persuade the market that he's seen something that the market has missed, and the market will see it. And there are times when the market won't see it. And so you can get periods of underperformance, even when the manager is completely right. And investors have to bear that risk in the short term. In the long term, it all evens out. If the manager has insight, there should be outperformance over time. And the secret here is to ensure that the manager has sufficient backing from the board to be able to carry out that investment over a long-term perspective, and not be distracted by short-term underperformance, which may be a good thing. Remember what Warren Buffett says, when a stock goes down, he says, I take a look and see whether I should buy more, because I'm a long-term investor. And I think that's very much my philosophy. But you also have to be careful that you understand why the performance is what it is. And that's the role that the board has to really delve into. And so on the Edinburgh case study, it was a process of escalation. Once you understand what the manager's trying to do and how he's doing it, you need to take a look at the way in which risk management is working around that proposition to ensure that the right risks are being identified and that the manager is being given the opportunity, the information to react to those risks in the right way. And in 2016, that fund, which is a very standard UK fund, underperformed very significantly. And it underperformed very significantly because the manager at that stage was invested in mainly domestic UK stocks. And as you know, the benchmark in the UK is a very international benchmark, carrying a lot of dollar exposure and a dollar risk. And I pointed out to the House at that stage that I thought that there was a risk there, that if there was a very sharp move in the sterling dollar exchange rate, that this could affect performance either very positively or very negatively, depending on which way sterling moved. And after the Brexit vote, sterling, remember, dropped very sharply, and the performance deteriorated very sharply indeed. The question was, did the House pick this up, and had the manager reacted to this? And I came to the conclusion that the House hadn't picked it up in the way that I expected, and the House wasn't going to manage that risk. And we tried to get the House to focus on this and to think about this in that kind of structural way about what kind of underlying currency exposure. This is very standard UK investment trust. But you have to think about these things because the UK market has a lot of FX risk in it because it's such an open market. We had a debate between the board and the manager where we didn't agree. The board, of course, is not going to claim expertise on this. So we brought in an outside firm to help us, TWT Towers Watson. And we concluded that we were taking too great a risk in continuing an approach which did not provide sufficient backup for the risk management of the currency. And that was really the reason that we moved in the end, that we were looking for a management house that had that kind of risk aspect to it. So, answer your question, Jonathan, I think we did the right thing at the right time. Whether we should have spotted this earlier, I think is very difficult to say. But I think the process of escalation is the right one, which is that you start with a small step and you move on. But all the time you have to remember that you're ultimately trying to back the manager into taking long-term perspective.
Yeah, it is a difficult balancing act. I've had some experience of that myself. But basically, you feel you have to give the management house time either to alleviate your concerns or, if some cases, change what they're doing to accommodate your concerns if they're well justified.
Or for the market to see it. Because sometimes the problem is not the manager, it's that the market doesn't see it yet. And they will eventually.
Right, but that was not the case in this particular instance.
Exactly right.
I'd also like to ask you about the manager who you chose to replace Mark Barnett and Invesco Perpetual. How did you come to the conclusion to arrive at the destination you did? Obviously, there were a number of similar trusts that actually did change their strategy at that time, and some of them worked very well and others have not worked so well. So you fortunately found a good solution. At least that's how it's proved so far. So what was the thinking and why did you choose the managers that you did at that stage?
Well, you won't be surprised to hear that in the UK, there are a lot of very talented managers who understand the UK stock market. So we weren't short of choice. There were lots of houses that had significant in-depth research in the UK market. We came across two problems. The Edinburgh Fund was over £1 billion, and that is actually quite a large fund for a lot of managers to absorb, given their own position limits in their other portfolios. And that eliminated quite a lot of people, or at least they eliminated themselves from consideration, because they didn't have the capacity to absorb a fund of £1 billion in the sterling product, in the UK product. And then from that, we had a balancing act because we were an equity income fund and we didn't want to change the dividend too much because obviously a lot of people are relying on an expectation of dividends. So we're looking for a value strategy rather than a growth strategy where you take a low income and higher growth. Very important in the UK market, and particularly when you have a lot of retail shareholders for whom income is a very important consideration. And that eliminated another group of people in the UK market who have significant talent but really didn't fit the product specification that we needed. And that brought it down to, I think it was 8 or 9 very good houses that had the skill, the capacity, and the ability to run an equity income fund of the kind we were running. And we chose Majidi, as it was then, to do that. We thought the best. We had an interview with, I think we interviewed 5 houses, one of which was Invesco, to do that. And we chose Majidi because it fitted that criteria, and we thought that the understanding of the product was very good for us. And I think it has proved to be the case. I think the performance has been fantastic. The fund has borrowings that are below the UK policy rate at the moment, which is absolutely amazing. So I think it's doing extremely well, and it's a fantastic fund, to be honest.
So I guess the only issue that you might have been concerned about was the fact that, Majidi is not a particularly large fund management house, but in terms of resources, you felt that they had those resources to manage such a large portfolio, and indeed, the management firm has been sold to a larger company, Land Trust. But that wasn't a concern for you at the time.
Well, we identified it as one of the issues that faced the house, the financial stability of the house. And we had reassured ourselves that if a problem had really arisen, that the house could manage it, that they had a way through it. And so it proved.
So that was Edinburgh, and that has worked out well. We obviously don't know what the alternative might have been if Investigator Perpetua were plugged on, but I think they would have struggled to do as well as it has done subsequently. So that worked well. And then you decided to take on another chairmanship with something completely different, which is Impax Environmental Markets. So what was the appeal of Impax Environmental Markets, and why did you think that you were qualified to be the chairman of that, if I may ask that rather blunt question?
I spent virtually the whole of my career, now almost 40 years, working in energy, first as a investment banker at Clymer Benson, been involved with advising the UK government on the privatization of the electricity industry in Argentina, in Brazil, in Asia. In Europe, I came back and headed Morgan Stanley's energy team in Europe in 1994. And when I joined Knight Vinke, really it was the energy focus. And one of the things I began to see over the course of my career is that sustainable investing had become really very, very interesting right through the energy area. And I knew quite a bit about it as a result of that. We had known for a very long time from my work at Knight Vinke and before that Morgan Stanley that solutions to climate change and sustainable investing were potentially areas of significant profitability. And I'd approached that before as an investment banker and then at Knight Vinke as an investor. But that was the appeal, that I thought that this was actually a really interesting space to be in, and one that offers very significant alpha over the next few decades. I mean, if you're looking long term, it's pretty clear that's where we're going.
So one of these things about Impax, the investment trust, is that it's actually been around for quite a long time. Everybody thinks that there was suddenly this sort of burst of interest in ESG and sustainability and similar kind of things. But in fact, this trust has been around since certainly back to the start of the century, more or less.
Yes.
And for a while, they had some peers in its peer group, the environmental sector, the investment trust sector, but they've all kind of disappeared now. So you are the lone standard flyer in that sector. But the trust had an excellent long-term performance record, but it has been cyclical. Let's put it that way. So things went very well for a period up to about 2021. You traded at a premium, issued quite a lot of shares. And then, along with a lot of other trusts, unfortunately, that cycle changed. And since then, you moved out to a discount, as I said, around 10%. And the performance has not been so good. And you've actually bought back shares. I think you bought back around 60 million or something like that. So in terms of share count, you're back to where you were, more or less, I think, about 5 or 6 years ago. How much of a concern is that, given that you say this is a long-term investment vehicle? We've been through a cycle. There was a time at the end of 2021 when more than half the trusts in the whole industry were trading at a premium. Now they're all trading at a discount, bar a few. How concerned should you be as the chairman of Impax Environmental by the fact that we're going through this cyclical phase? You have just passed a continuation vote very easily. So obviously your core shareholders are very happy to carry on with the formula, and you are a large trust. So how concerned are you by this rather extreme volatility we've had?
Well, I think the board has a job to do, which is to understand all the various bits that go to make a successful investment proposition. And we have a number of different things taking place at the same time. We have a negative outlook for a very long time on the UK stock market, which we all know is now still trading at a discount to some of the global markets. This is affecting investment trusts. We know that the investment trusts in the UK are all trading at a discount to net asset value. And then we know that the environmental sector has been under pressure as well. So those three things have nothing to do with the manager. And then we have to ask ourselves, is the manager doing the right thing, given all of that, in all of that? So it's quite a bit of work for the board to do and to get its head around. The continuation vote was an opportunity for investors. We had an opportunity last year, go and talk to our investors about the investment proposition, ask them, have we got the right investment proposition? Are we covering the right markets? Are we doing it in the right way? Do we have the leverage that you want? Do we have the governance that you want? And then broadly, investors were happy to proceed with the investment and gave us their backing to continue. It's not a blank check by any means. I mean, the board has to continue work, make sure that the manager's performing in the way that we expect, even if there are difficulties in the market. But I think that's the problem that we're facing. It's not just, is the manager doing something that they shouldn't be doing or they're not performing? It's the whole series of issues, which are unprecedented, let's be honest, for this part of the sector. I mean, as you rightly point out, all the competitor funds have basically gone to the wall.
They have all gone to the wall, and a lot of them are a lot smaller, of course, and they've had size issues as well. So what did you do as part of this kind of review process? The continuation vote presumably was a useful trigger, or perhaps an incentive to do a thorough review of the management's approach. So what did you do? How did you go about trying to strip out the things that they were responsible for and assess those, as opposed to, as you say, this unfortunate combination of external factors that has not helped at all in the current market?
So after the AGM in 2024, the board decided that with the AGM in 2025, with the continuation vote coming up, that we should take a look at the whole proposition from scratch and rethink whether we had the right investment for investors, and then come back to investors at the AGM in 2025 with a completely new proposition, if that's what we thought, or with a recommendation to shut down the fund if that's what we thought, or to continue on the same path if that's what we thought. But the brief that we gave ourselves was absolutely nothing off the radar screen and nothing off the agenda. And that involved looking at why the fund was underperforming the ACWI benchmark, which is the main benchmark at that time. And then to interview the managers to understand the various processes. What was the quality of the research that they were doing? How did they create their portfolios? How did they manage risk? Did they deal with concentration in the right way? Were they looking at gearing in the right way? And we did this over a period of months where the manager presented to us on each aspect of the strategy so that we had the opportunity to grill them and question them and ask further questions and ask for more information about all of that. And I think on our board, we have sufficient number of directors with sufficient investment knowledge and experience to be able to understand those things and to grill the managers in the way that our shareholders would expect, and to form at least an initial view on whether what we were being told lay within the acceptable ranges for a manager managing a fund of this kind. And then once we had done that, we were able to go to investors and get their views. And so we had a whole process, I think it lasted 4 months, of consulting investors on exactly the same things, trying to test whether investors understood the proposition in the way that the managers were describing it to us, or whether there were any disconnects between the expectations of the investors and what the managers were doing that the board had missed. I mean, there are always going to be some mismatches, but whether the board had missed, whether the time horizons of each were similar, because obviously the investors have a really short-term horizon and managers are managing a really long-term horizon, then we might have a problem that we have to address. So a complex exercise. And then we had a strategy day where we'd be able to put all the pieces together and say, okay, are investors happy with the remit of the trust and the mandate? And do they understand? And are they happy with the way in which the manager is operating, the benchmarks, etc., the risk that they're taking? Where does this fit in the portfolio of managers? You know, how do they see this in terms of their overall asset allocation? And what should we do about that? And then lastly, the question is, communication. Are we communicating all of this in the right way? And it was really opportune for us to do it at that time in the second half of last year, because it gave us a chance basically to deal head on with what is called the ESG backlash as well, because we were able to understand exactly how our investors were thinking about that, but also dealing with the issues about the UK stock market, the difficulties, and the broader issues of the investment trust market and the discounts that have appeared across the sector.
Right, so that was a fairly comprehensive and time-consuming process. You mentioned in the annual report that another issue that you had to address was the fact that, I guess I can't cast in question the viability of Impax Asset Management, but the fact that the management company, which manages the assets of this trust, has lost a significant client, and its own share price tells a story. It's not been performing at all well in the last few years, and it has obviously shrunk. How did you address that particular factor, and how did you arrive at the conclusion that you were happy to press on with them?
Obviously, that's one of the considerations. It was a consideration with JD before, so it wasn't a kind of new thing for me particularly, and I don't think the board thought it was a new thing either, that we're constantly looking at. You know, small managers like Impax have very distinct advantages when it comes to specialist investment. And the question is, how do you get that specialist knowledge, because they see things differently, to the market, while balancing it against the broader risk that small firms by definition are going to be a little bit more volatile than larger firms. And we were able to interview Ian Sim and his colleagues to understand exactly how they thought about this problem and what the challenges and risks that they faced were. I mean, it wouldn't be appropriate for me to talk through all the details on this, but suffice it to say here that we reached the conclusion that for investors, our investors, this was a manageable risk that the management of Impax had under control, at least for the period of the investment horizon until the next continuation vote in 3 years' time, and that it wasn't going to distract the manager from making long-term investments, and it wasn't going to compromise the ability of the manager to deliver performance in line with their skills, which we thought were, superlative, to be really honest. Very, very strong skills to the manager. So it's a balance, and we keep it under review, but we broadly came to the conclusion that there is a risk here, but it's a risk that we should be taking.
Okay, now your share register is interesting. You have a significant holding by one of the wealth managers, Rathbones, but you also have Saba Capital on your share register, or at least did at the time of the annual report, with a 5.78% holding. Can I ask you how your dialogue with them has proceeded, if you've indeed had any? What's been the story there?
The way I think about it is Saba are an investor on our register and very welcome to be an investor on our register, but they are an investor. They're not different from other investors, and we listen to what they have to say. We think about what they have to say. We think about what everybody has to say. We went out and talked to virtually all the big shareholders last year, and Saba fits into that framework, that we took that all into account, and the board's job is to make the right decision for all the investors. Quite normally, Saba tells us what they think and what their perspective is, and other shareholders do the same thing. But it's not our job to basically act on one shareholder's point of view or interests. And to be fair, I don't think that we are under pressure from one shareholder to do something that other shareholders, if we came under that pressure, I think the board would have to take a view on what was the right thing for the whole register and all the shareholders, having listened very carefully. Knight Asset Management, by reputation at least, is an activist investor. I know that activist investors do a lot of work. They do see things that other people can miss. And so boards have to listen. And I was very, very careful and very conscious of the fact that they were saying things, probably a great deal of research, that I should listen to. So we've come to the conclusion we've come to, and that represents what we think is the best thing for the shareholders as a whole. I think that's the proper governance position on this.
Yes, treat all shareholders alike. So did they back the continuation vote? I must admit I haven't actually looked at that. I don't know whether they did or not.
I don't think they disclosed it, and we don't disclose what other shareholders did either.
Okay, but you did have dialogue with them, and you did speak to them, and you listened to what they had to say. But did they actually have a plan for the trust that was different in any material respect from what you were planning to do?
Well, look, I think it would be entirely inappropriate for me to disclose the conversations with any shareholders, and that includes Saba. They haven't said anything, and I shouldn't say anything.
Okay, that's fine. You are listening to our Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Anyway, let's talk about the trust then. So here you are, you've got still a sizable pot of assets, you've been facing these three headwinds, and one of the interesting points about the trust, I think, and I don't know how important this was when you were discussing with your shareholders ahead of the continuation vote, is the fact that you invest mostly in listed equities, global listed equities. You have currency exposure yourself. But how important is the argument that I have seen made that the portfolio you have is uncorrelated with other markets? Is that a key selling point for this particular trust?
Yes, absolutely. That was the message I got back from the pool of investors that I saw, which is that for a large number of investors, The proposition that really attracted them was the fact that this was the uncorrelated portfolio that matched the exposure they had to the Mag 7 and the big companies in the NASDAQ, etc. And that this was part of the portfolio composition that they had, that it was a risk mitigation strategy which had an option, if I can put it in technical terms, an option on the upside. I thought that our investors had a very sophisticated point of view on this, the bigger shareholders on this, and I now understood completely, in a way that I probably hadn't understood before talking to them, where this portfolio sat in their other portfolios. And that obviously means that you have to communicate in a slightly different way to the group of investors for whom this is an important issue, because there are other investors who are not interested in the correlations and the way that risk works. And obviously retail shareholders aren't buying it always for those reasons, or mainly for those reasons. But it is a very important argument. But there are two important consequences from this. One is that because it's uncorrelated with the stocks that are driving the ACWI, you're almost systematically going to build in some level of volatility against the ACWI that leads to what people say is underperformance. And they are flip sides of the same coin. Because obviously you're holding it because it's uncorrelated. By definition, it's not rising when the Mag 7 is rising. And if the Mag 7 are driving the ACWI, you are going to be underperforming the ACWI. And you regard this as a desirable quality because it is uncorrelated. And it's very important to make sure that the underperformance is not being driven because you're actually trying to be correlated and you turn out to be underperforming. It's driven by a set of stocks that are performing in the way they do, but are not correlated with the Mag 7. Very technical issue, but it's a very crucial issue when it comes, because you see, I hesitate with the word underperformance in this context. I know what the market is, and I'm not a fool on this subject. I know the market looks at it and says, well, it's on the data, it's on the screens, etc. It's been underperformed. It's not completely the way that our investors look at it, and it's certainly not the way in which I think you should be looking at it. But that creates a problem for the board and for the manager, which is how do you communicate in a simple way how good or bad your strategy is when the desirable quality is actually the uncorrelated nature? You understand the argument there. It's a very sophisticated, complicated issue. And I think the board's got to take a view on this and a stand on this so that investors have some guidance about where we stand. Now, one thing that we said we would do, it's in the annual report, is we would think about a benchmark that is more specific to sustainable investing. And then that would allow us to measure the manager's performance more precisely, regardless of how the ACWI is performing, because obviously that issue of correlation will still be there, but it'll be the strategy as a whole. It's the whole environmental markets that are now offering uncorrelated exposure to the ACWI, rather than trying to manage the manager against the ACWI. I hope I'm making sense on this. So that we now have a more granular way as a board to measure performance and for investors to see how correlation works against. And that bit of information could be very valuable to investors wanting to position this in their portfolio. And then the last thing to say on this is, there is a competitor out there, mostly in the public markets for active management or for active funds. And that is the index funds, the ETFs and all the similar products. A lot of people say, and I certainly agree with this, that investment trusts have a very specific role to play in finding things that you don't find so easily in the index. So unquoted exposure, small markets, that kind of thing. But sustainable investing is one of them. And it's one of them because actually there are no big sustainable investing indices that stand out with a lot of capital behind that. And that means that, and this is another case where the desirable quality of the fund, which is that it offers you exposure to something that you don't find, you can't just go out and buy an ETF on a sustainable investing fund. You have to come to an active manager, actually creates the problem that we have, which is that how do you measure that performance? So this is what the board is thinking about right now, which is how do you calibrate to give both the investors the right information to make strategic asset allocation decisions and the manager to make the right risk decisions. And the board is right in the middle of this. This is the central issue that the board has to consider. I hope we're going to come to the market soon with some conclusions on all of this, but that's what we've been thinking about since the continuation vote. In fact, before the continuation vote in May.
Right, and that's a complicated challenge, therefore, you have. Can I just clear up on one point, though? When we say it's uncorrelated, we're not saying it's negatively correlated, we're saying it's uncorrelated. Is that right? So in other words, it doesn't automatically go down when the market only goes up. It's uncorrelated. In other words, its performance over time is not correlated with the markets.
Exactly.
But it just happens to be the case that You don't own any big tech type companies because they're not in your mandate effectively. And so to me, it makes sense to have a new benchmark if you can find one that actually does reflect what you're trying to do and which the shareholders can have confidence in. Because, of course, it's always a slightly worrying thing when funds change their benchmark after a period of poor performance because people think, oh, well, you're just moving goalposts, right?
Yes, as I say to myself, it's like saying I can score goals with my left foot, and I would like a rule that says that only goals scored with the left foot count. Quite right. I agree with that. The benchmark has to command market confidence, and it really must be seen as a standard by which the manager can be held to account. I mean, the question is, how does the board test the manager in these circumstances? And we've adopted two approaches to this, which I think your listeners might be interested in. One is to ask ourselves, what is the batting average, if you like, of the manager, to use a cricket metaphor? So we're looking at what the managers said that they thought their stocks could achieve in terms of earnings performance and what they actually achieved in terms of earnings performance. And how did that compare with the ACWI? So the benchmark that was out there. And we found that actually the results were surprisingly consistent and surprisingly optimistic. I mean, there is real skill in the management team, and it is statistically significant. It is verifiable that the team at Impax are seeing something important about the sustainable investment companies in financial terms. I mean, I'm not talking about the broader issues about the social advantages of all of this, which also matter, but I'm just saying that from a purely investment point of view, I can see that the team at Impax really does have an edge, an alpha edge. And if the markets perform as we expect over the long term, which is the Mag 7 cannot simply double the valuation multiple again in the next 10 years, having almost quadrupled its multiples in the previous 10 years, then there is a reasonable prospect that the strategy as a whole will basically move into favor against the ACWI. The uncorrelated thing helps us this time as opposed to being our headwind. But the question then is, has the manager picked the right stocks? Because the whole sector goes up. The question is, can we get alpha on top of that? Which is what we're looking at. And as I say, I think the managers do have some skill in all of this. And I've said publicly that they have my backing.
I should perhaps just throw in here, for those who perhaps aren't familiar, when you're talking about the ACWI, you're talking about the All Country World Index, so it's a kind of global equity index. Yes, that's very interesting. Well, a lot of people did say, though, that when the kind of ESG sustainability became fashionable or popular, a lot of people said it was actually a growth strategy in disguise. But you're saying it's not quite like that. Earnings are performing ahead of where they would expect to be on the manager's forecasts. But is it actually a growth strategy, or is it a value strategy, or is it some combination of both?
The G of ESG is mostly well done, I think, in the market. Investors understand that they're not mispricing governance. Everybody understands that very well. The S is very contentious because, it's about what social legislation you have, etc. And my view on that is that ultimately is a matter for politicians to decide where they're going to put the barriers on how long people work for, when they start working, I don't know, women in the workforce or minorities or whatever it is. That's a political matter. And the politicians decide that. The E, on the other hand, is both a political matter, but an investment matter. The political matter we all know about, which is where do we make the compromises between the sustainable investing and our current living standards, etc. And obviously there's a whole social dimension to that, which is being discussed in legislatures all over the place. But there's an investment side to E. And the investment side to E is, what risk does your company face from environmental factors? And what advantages do you have from environmental factors? So let's give you a very concrete example of this. If you're running a water company in the UK and you found that actually, in order to manage your business, you've got to discharge effluent into the rivers. At the moment, the cost of doing this is very low. Is this an advantage or is this a risk? So on the balance sheet, we might not have an item saying liability for discharging sewage into the rivers in the UK. But everybody knows that the population is very aggrieved by this. And that if it's not there in the accounts, it's damn well going to be there very soon. I'm sorry about the language. So it is a risk. Regardless of what the political system says, you have to take it into account. It's going to be there. And that's a short-term risk for a water company. Some risks are over the long term, which rise over the long term. So we know that rising sea levels are going to be a problem. Some companies are going to find it difficult to manage that. The Netherlands is already quite significantly underwater and is protected by seawalls. Those seawalls have to go up further if nothing happens. We know that it's very hot now in the summer in the UK, but all over Europe. We're going to need air conditioning. We are absolutely going to need air conditioning in the summer. And that's an opportunity for manufacturers of air conditioning and all that kind of equipment, etc. People who build seawalls, a huge advantage. We know, I'll give you another example. I do a lot of work on renewable energy. Solar now costs 1% of what it cost 20 years ago, 1% of what it cost 20 years ago. We're getting to a point where it is so cheap that we could actually manage to manufacture renewable hydrocarbons. And if we could get that, within our price point here, if we could manufacture the hydrocarbons, renewable hydrocarbons, we could run our cars on petrol, which is renewable. We could run our CCGTs, our gas plants, on renewable gas, etc., with renewable hydrocarbons. And a lot of the things that we do could be managed within the current budget, where we'd have electricity at very low prices, but if you wanted to run hydrocarbons, you'd pay current prices. Some people might like that. It may be the solution. These are the kind of things that sustainable investing and the whole field that we are involved in has an advantage. I'll give you another example. Water. To create a cubic meter of drinking water in the UK costs about £1 per cubic meter. In Bahrain, they desalinate seawater using gas. Costs them about $1.60 per cubic meter. But if you desalinated the water using solar, it costs about 30 cents a cubic meter. You might not have to build all the reservoirs in the UK. If you use solar to desalinate water, you could have an endless supply of drinking water. I mean, there's seawater everywhere. Endless supply of drinking water for all sorts of purposes. Irrigation, places in Africa which have a lot of sunlight but not enough water, etc. There's a huge amount of opportunity here over the next decade that we have to find. I'm giving you the broad themes. The manager has to find the right companies that have the right earnings, the management, etc., that deliver that. And I'm saying to you that I think they have. I think you said to me they're the only ones in the market. And I'm telling you, yes, and they're also very good. That's why I'm very confident about IEM.
So one of the fundamental problems, though, as you said, is the fact that these issues that you've talked about and the potential you talked about, they require a long-term thinking and long-term investment, right? And that's something which is often in short supply, both politically and in terms of investors, shall we say. I think that's probably not contentious. And a good example of that would be our friend Mr. Trump in the US. What are your thoughts about what he's doing and how will that impact on the kind of growth of the industries that you are talking about and your managers are looking for?
Well, undoubtedly. So President Trump has a mandate to do what he's doing, and some of what he's doing have negative consequences for particularly energy. That has to be taken into account in the investment process, and we've got to decide whether that makes sense, whether we invest in that or not. But President Trump is not an issue for companies that are cleaning up waste product, delivering clean water, that kind of thing. And there are still opportunities there. I think President Trump is just another issue that we have to factor in into the portfolio in the same way as the Indians and the Chinese have adopted policies which have to be taken into account. Portfolio manager is not there to make a comment on politics or so, but take into account and decide how to allocate the portfolio. And that's really good because they've got the analytical skills to be able to say, okay, this is the consequence of what the president is deciding in the United States or the prime minister in India or the rulers of China, which are the three big areas. And yet, as I've just said to you, that the E part of ESG has a political side, but it definitely has an investment side. And even sometimes, if the politics isn't going in that way, the population is. People are voting with their feet sometimes. I'll just give you an example of this. In Pakistan, they had an electricity system that was basically generating electricity from LNG and coal and produced very high prices. And after the IMF restructuring of Pakistan, the subsidies were eliminated and prices went up. But guess what happened? In the last 24 months, solar panels and batteries from China have crossed that Pakistani-Chinese border in such great quantity that Pakistan has become the third biggest importer of Chinese solar panels in the world. I mean, that's huge after the European Union and the Americas. And people have set up in their own houses solar panels on the roof and batteries in the basement and are supplying their own electricity for a fraction of the cost of the grid. They have walked out of the system. But if you look at the Pakistani grid, it looks like electricity demand is falling. But it's falling only because the measured electricity on the grid is falling. But you can see the dynamics there of how the political side and the investment side are working, which is even if you wanted to, sometimes you cannot stop the waves.
Right, but something like Trump may certainly have an impact on the kind of things that you're investing in the short term. That would be true, I guess.
Yes.
Well, it's a very enticing proposition and a challenge, I guess, to the investment community to step up to the plate if they agree with your premise and your assessment of what this particular portfolio management firm can do. On a very kind of boring technical point, the dollar weakening, is that an issue for you? How do you deal with that? Do you hedge it or not? What's your approach to that? Because that is a board responsibility too.
Yes, because the portfolio is so diversified geographically, its underlying base is probably the dollar. The only issue is that the shares are traded in sterling in the sterling market. And so that does create a little tension between how the shares trade and how the net asset value trades. And this is relevant to the discount because, of course, the shares are trading by reference to what the Bank of England is doing on UK interest rates, and the shares, the NAV, is affected with what the Fed is doing and US interest rates. And when UK interest rates and US interest rates are moving in different directions, the discount basically reflects that. There's a concertina effect, both driven by how the NAV moves in relation to the shares, but also driven by how investors are behaving in relation to the UK market versus the US market. It is a very complicated issue, and it is not simply, when you look at a discount, you say, well, the investors have lost confidence or not. It's an investment issue here that needs to be grasped at the end of the day, and it offers both risk and opportunity. I mean, in the long term, if you believe what I'm saying, there's significant opportunity regardless of where the discount is. If you didn't kind of look at it at the very long term, you would kind of come to the conclusion that, well, the discount's been there for 10 years, I might make 10% on closing the fund down. Now, our shareholders had an opportunity to consider that thought and that argument of the continuation vote. They've decided they didn't want to take that view. In my view, quite rightly, that was the recommendation of the board. So I think it is a significant issue. These discounts are not simple issues. They are actually about flow of funds between the UK and the international market. And I think boards have to be a bit more, I don't know what the word is. Thoughtful is the wrong word, but it requires a little bit of thought about how you manage it. It would be different. We at IEM run a great big geographically diversified portfolio. So we are going to have a net asset value in dollars probably, come what may. And our shares are traded on the London market, they're in sterling. I mean, that's how it is. I suppose if the shares were listed in New York, problem wouldn't rise to such a thing. I just don't think that our shareholders want that. But you can see that if the shares were traded in dollars, this problem would be mitigated at the cost of UK investors not having the opportunity to invest in this, or European investors. So you've got to think about all those issues when you're thinking about discounts and performance. I'm always thinking, is this the right thing in the long term? Is that the right way to go forward?
But you have been buying back shares. As I said, I think the share count has gone down from around 300 to 240. So that's around 20%, something like that. And you're going to carry on doing that, are you? Are you defending a specific target, or what do you think is a reasonable range for this particular trust, given all those issues that you just discussed, which are not simple?
I would say that if a board is convinced that the strategy makes sense in the long term, then it is absolutely right that it should defend or provide liquidity in the form of buybacks in the short term. And that is for two things. One is that investors are looking for some stability on the discount in terms of the volatility, but they're also looking for a level of the discount. And in the very complicated markets that we have right now, where there's uncertainty, particularly on the sterling side, sterling moved by 1% just this week, I mean, which is, quite dramatic. But also on the US side, where obviously the dollar has now started dropping, etc. Some short-term liquidity does help if it doesn't cost the fund any kind of issues in terms of costs and scale and all that. And that's the position we've taken, is that we are able to offer that, and we should, to help investors who want to rebalance their portfolios now, because there is an opportunity in the long term.
So before I give you a final chance to describe what is the investment case for this particular trust at this particular moment, at this particular price, can I just ask you about the comparison we're making with Bluefield Solar, where you're not the chairman, but you're the non-executive director, where they're trading on a much wider discount, steadily been widening, and they are more constrained because they have more gearing and they've got assets which perhaps are not as readily realizable. So they require a different approach, right? And do you think that the market's not reading that one correctly?
No, it's a different situation completely. It's an operating company. It runs almost 5% of the UK solar capacity. It's managed as an operating company. Selling assets is not the core part of it. It's not managing a portfolio dynamically in the way that IEM is doing. It is capable of being levered. Credit considerations are much more important than they would be for IEM, because obviously we're dealing with the cash flows. And so that's like thinking about running a utility. So that's like my old world, thinking about running a utility, credit, whether you've got the right PPAs in place, or you've got the right price hedging in place. It's a different consideration. Very tough for investors in the investment trust market dealing with that situation. partly because the information is slightly different from the information they would normally see for an investment trust. If you were running SSE or Centrica, you wouldn't be asking what the discount is. You just wouldn't be asking that question. And yet, because Bluefield has a discount, people say, well, it shouldn't have a discount, or discount's too big, etc. And it has an effect on the ability to raise capital, because obviously, it's very difficult to raise new capital when you're at a discount. But a utility company, SSE or whatever it is, Centrica, doesn't face this difficulty regardless of what you think the net asset values are in relation to the share price. That's a different situation, different challenges there.
So are you saying this is a market failure in terms of the renewable energy trust at the moment?
I wouldn't use the word failure, but I would say that the opportunities are bigger than the investors are willing to give credit for right now.
Okay, so thank you. I've sort of diverged a little bit there, but let's come back to this IEM then. And why don't you just make us the case for why we should be looking at this today, at today's price, at today's discount, following the continuation vote and pending the new benchmark, which will help us to understand what you're really doing.
Well, thank you for that. Sustainable investing is one of the mega themes for the rest of the 21st century. Let's start there. Along with aging and demographics and technology, of course, it is one of the mega themes. And we all know that climate change is a reality that is affecting the way in which we live. And we all know that there are companies and there's human ingenuity producing solutions to these problems in the form of air conditioning, cheaper power, green technologies, that kind of thing. We have in IEM a manager that has insight into those trends and those companies and that market. We have, at the moment, as you rightly point out, a discount to the net asset value. And you have, thirdly, I hope, a board that is thoughtful and diligent. And I think the combination is really quite interesting for investors looking for something over the long term.
Well, thank you indeed, Glen, for your taking the time to talk to me for this podcast. It's been very interesting and fascinating. And for those who believe that the investment trust structure is ideally suited to pursuing specific, often different kind of strategies than you'll find elsewhere, then IEM certainly meets that criteria. So thank you very much for sharing all your thoughts with us in such an open way. So that was Glen Suarez, the chair of Impax Environmental Markets, ticker IEM.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.